In the world of candlesticks, there are many different patterns. However, there are only a few that I found to be really effective when traded the right way. In today's video, I will share two price action patterns to spot reversals and high probability signals, namely the piercing line and the dark cloud patterns. Piercing line pattern is a candlestick formation formed near the support levels, and it gives you potential bullish reversal signals. It is found towards the end of a downtrend and is quite similar to the dark cloud cover. The only difference is that the dark cloud cover signals bearish reversals, while piercing line pattern signals a bullish reversal. So the piercing line is a bullish reversal pattern that can be found at the end of a downtrend. This candlestick formation is used as an indication to enter a long position or to exit a sell position. Piercing pattern is formed when the bulls and bears both are fighting to gain control over the prices. The first candlestick should be red, having a large real body, and the second candlestick should be green, and also should be below the low of the previous candlestick. Also, the second candlestick must close above the middle of the real body of the first candlestick. Here's the formation of the piercing line. We see that the market is in a downtrend and the selling activity predominates. Here's the first piece of our pattern, with a bearish candle being formed. This bearish candlestick is usually a big body candlestick, having no or very small upper or lower shadows. The opening of the next candlestick is below the closing point of the previous bearish candlestick. Next, there is an increase in demand by the bulls and the price starts rising. At the end of the day, cause we are on a daily time frame, the bulls are successful in making the price rise, and the closing price is more than the middle of the previous bearish candlestick. Now, you must look at 5 characteristics when you search for the piercing line pattern. Firstly, the trend should be in a downtrend, as the piercing pattern is a bullish reversal pattern. Secondly, the length of the candlestick plays an important role in determining the force with which the reversal will take place. Also, the gap down between the bearish and bullish candlesticks indicates how powerful the trend reversal will be. Fourthly, the bullish candlestick should close more than the midpoint of the previous bearish candlestick. And lastly, the bearish as well as the bullish candlestick should have larger bodies. Here, we can see that all of the characteristics mentioned for the trend reversal signaled by the piercing line are fulfilled. There's a downtrend. We have a large bearish candle. We have a gap down between the two candlesticks, and the bullish candlestick closed above the midpoint of the previous bearish candlestick. When you see a piercing candlestick pattern on a particular market, you could enter right away at the close of the second candle, or you could wait until the high of the first candlestick is broken. The stop loss should be placed at the low of the previous bearish candle. This pattern is more suitable for swing traders, as from my backtesting, the rate of success is quite high in the longer time frames. The dark cloud cover is the opposite of the piercing line, being a 2 candlestick pattern that is created when a red candle opens above the close of the prior green candle, then closes below the midpoint of the up candle. When you spot a dark cloud cover pattern on a Japanese candlestick chart, you expect a potential bearish reversal. To identify a dark cloud cover, you look for the following criteria. An uptrend must be occurring. The first candle in the pattern is a large bullish candle. A bearish candle must follow the bullish candle. The bearish candle must pass through the midpoint of the previous candle. It must open above the high of the previous candle, and it must close more than halfway down the body of the previous candle. Confirmation of the pattern is achieved when another bearish candle forms after the second candle. Here are some tips on analyzing a dark cloud cover pattern when you see one. The higher the gap up is from the previous candle's close, the bigger the reversal will be. This shows that the market was unable to sustain that high price level. The longer the bull candle and bear candle are, the more pronounced the reversal will be. The lower the bear candle closes into the bull candle, the stronger the reversal will be. And if the volume is high on both candles relative to the previous candles, the reversal is more likely to occur. Also, make sure that the dark cloud cover pattern you're seeing is not a bearish engulfing candle. They're very similar in appearance. If the second candle closes below the previous candle's open, you have a bearish engulfing pattern and not a dark cloud cover formation. Here's an example. It starts with a bullish candle in an uptrend, followed by a gap up the next day. The candle of the next day turns to be a bearish candle. The close of this bearish candle is below the midpoint of the previous candle. The bullish and bearish candlesticks have large real bodies with very short or no shadows. As in the case of the piercing line pattern, you must look at few characteristics when you trade with the dark cloud cover pattern. Firstly, the trend should be in an uptrend, as the dark cloud cover pattern is a bearish reversal pattern. Secondly, the length of the candlestick plays an important role in determining the force with which the reversal will take place. The gap up between the bullish and the bearish candlesticks indicate how powerful the trend reversal will be. Fourthly, the bearish candlestick should close more than the midpoint of the previous bullish candlestick. And lastly, the bullish as well as the bearish candlestick should have larger bodies. Before you know how to trade with the dark cloud cover and the piercing line patterns, it's important to know when to avoid trading them. While they are considered reversal candlestick patterns, what you don't want to do is to trade them without context. And what I mean by that is don't trade them every time they appear on your chart. When trading any candlestick pattern, you want to see the context for its formation. This means whether there is any chart pattern that forms during this time, or whether there is any support or resistance levels that make sense for its formation. As with any candlestick pattern, you only want to trade it with a trade setup. Then use the candlestick pattern as an entry trigger. So how do you exactly get into a trade once the dark cloud cover appears? The entry method number 1, at the close of the dark cloud cover. The first type of entry is what I consider an aggressive entry. To enter into a trade using this entry method, you simply wait for the close of the dark cloud cover and then enter into a trade. This means once the second bar of the formation closes, you immediately go short using a market order. I consider this an aggressive entry because you don't wait for further confirmation that the market will go in the direction of your trade. Further confirmation is to wait for the market to either break below the low of the dark cloud cover or close below it, and that leads us to the next entry method. The second entry method is to enter into a trade when the market breaks below the low of the first bar in the formation. For this entry method, you could use a stop order. A stop order is essentially a market order, but is only triggered when the price reaches the trigger level that you set. So in this case, the trigger level is below the low of the dark cloud cover. When the market goes below the low, the order will trigger a market order to sell at the best available price. The stop loss for both entries goes above the high of the pattern. How to decide which entry method to use? Well, you decide which one suits you. Here are the pros and cons of using each method. For the entry method number 1, the pros are you can get a better risk-to-reward ratio for the same take profit level and much tighter stop loss than the other entry method. The cons are you get stopped out more often than the other entry method. For the entry method number 2, the pros are you have confirmation of the bearish momentum and you don't get stopped out as often as the first entry method. The cons are you get a worse risk-to-reward ratio than the first entry method. It's up to you to decide which entry method is more suitable for your trading style. To trade a dark cloud cover pattern, I look for pullbacks in a downtrend. In a downtrend, the market will make lower highs and lower lows, like this. These lower highs are the pullbacks in a downtrend. What I'm looking for is for the dark cloud cover pattern to form on these lower highs. But we don't want to trade every dark cloud cover that forms on a lower high. We only want to trade the ones that are formed on a dynamic resistance level. What is a dynamic resistance level? They are resistance levels formed by moving averages, more specifically exponential moving averages. So what I like to do is to plot two EMAs on my chart. You can choose any length you prefer. And what I'm looking for are the dark cloud cover patterns that form on either of these EMAs like this. The opposite is true for the piercing line patterns. Here are some examples of piercing line and dark cloud cover patterns on different markets. Regarding timeframes, you should look for the hourly, the 4-hour or the daily charts for these patterns. From my backtesting, the piercing line and the dark cloud cover are less significant in the lower timeframes. Another tip is to pay attention to volume. If the volume is high during the formation of the candles, there are more chances of the reversal to take place. Also, it's okay to confirm the signals given by these patterns with other technical indicators for safer entries. As always, if you learned something new and found value, leave us a like to show support, subscribe to our channel and click the bell icon to stay in touch when we upload the videos. Until next time.